Super bubbles can really wipe you out like 1929 did. And that's where we are now. We entered a few months ago into 3 sigma territory, super bubble territory. And the other great risk is last year we also entered bubbles in real estate. So this is a very dangerous year that we've just had.
Are we on the brink of a catastrophic economic collapse? Jeremy Grantham, one of the world's most respected investors, thinks so. In his latest warning, he says we are in a super bubble that could wipe us out, just like the one that hit in 1929. But what exactly is a super bubble, and why is it so dangerous? In this video, we'll break down Grantham's warning and explore what it means for the economy and for you. Stay tuned to find out how you can protect yourself from the impending economic disaster.
Some bubbles are very specialized to US growth stocks, like 2000. And they hurt. There is a wealth effect. People lose money, they pull back on their spending. But they don't hurt anywhere near as much as when you combine that with a housing bubble. So in 2008, where we had the only housing bubble in American history, that burst and the stock market came down 50% in sympathy. Then you're talking serious damage to the economy through the income effect. Because this time we have, as a multiple of family income, US housing suddenly is more overpriced than it was ever in the housing bubble of 2006 to 2008. And it got there this last year since we last spoke. The biggest increase, 20%, that the US housing market index has ever had has taken it to a new high. And they are, in the US, still much cheaper than Canada, Australia, New Zealand, London, Paris, etc. So that is a global event that could cause enormous pain. So we have a housing problem, we have a stock market bubble like 2000, we have overpriced commodities, oil is 88, and we have, of course, the lowest real rates in the history of man. Now you have a much higher ratio of debt to GDP, you have much more debt on the balance sheet of the Federal Reserve, and you have much lower rates. They will try, they will have some effect. There's some element of the put left. It is just heavily compromised.
According to Grantham, inflation hasn't been a concern for decades, but now has come back on the radar. In his opinion, inflation may not reach the levels of the 1970s or 80s, but it will always be a part of the discussion moving forward.
How worried are you about inflation?
I haven't written about inflation for 20 years. When I did quarterly letters, I never featured inflation. I didn't think it was on the radar screen. It is now on the radar screen once again. It's not that inflation will go roaring back to 1972 or 1982. It's that it will always be part of the discussion from now on, in my opinion. Instead of forgetting about it, it will be spiking and irritating and falling back and then spiking again. It will be part of the scenery in the way it used to be in the second half of the 20th century. There's a lot about this economy, I think, that will be dragged back into the late 20th century. We've had a very, very abnormal honeymoon Goldilocks period for 20 years, which I think is ending. Let me put it this way. We're in the early stages of running out of raw materials. Of course, we live on a finite planet. There's only a certain amount of cheap oil, cheap nickel, cheap copper, and we're beginning to hit some of those boundaries. And we're going to have bottlenecks here, there, and everywhere. The food price index of the UN is about as high as it gets. Growing food is not getting easier. Climate change is coming with heavy floods, serious droughts, and higher temperatures. None of these make farming easier. So we're going to live in a world of bottlenecks and shortages and price spikes, and we have to get used to it and learn to manage our way around it. Commodities have a long history of doing quite well when inflation picks up, for obvious reasons. And inflation is quite likely to pick up. Looking out into the future, it is pretty clear that we are running out of labor. Fertility rates have dropped like a stone. China is reeling from the shock of finding that it has 10.8 million babies last year. It's only the other year, 7 or 8 years ago, it had 20. And This means absolute certainty that the cohorts of 20-year-olds coming into the workforce will be smaller going forward. Everywhere in the developed world, we're below replacement in fertility. I think the Fed absolutely does not get the pain that's involved with a bubble breaking. You can see that in the history of the last 50 years. Greenspan encouraged the tech bubble. He bragged about the productivity gains from the internet that would last forever. Actually, productivity has declined slowly but surely since then. When it broke, it caused a lot of pain. Bernanke learned nothing. He encouraged the housing bubble. He denied its existence, even though it was a 3 sigma, 1 in a 100-year event that had never occurred in American history before. And what have we learned? We just went straight back into the game, overstimulating, pushing the rates down and down they have gone for 50 years. So they started at 16% on the long bond, and now the real return you would get is -2. They act as if a low rate is a panacea and comes with no downside. That is clearly nonsense. It's created, I think, the biggest evil in our society, and that is inequality. If you drive up the price of assets systematically, and it's bound to happen if you drive the rates down to negative territory, who do you make money for? You make money for the people with assets. Who owns the assets? The top 1% has 35% of all the assets. The top 10% have practically all the assets. What's the asset ownership of the bottom half? A rounding error, practically none. So you mark up the assets, and that's your contribution to society. What you're doing is pushing down on labor, pushing down on the bottom half, with no offset from increasing their assets, since they have none. And you're making the top 1% ineffably rich. And the data bears that out right down to the last 2 years, when the top 0.1% has doubled its wealth during COVID.
Grantham draws attention to the mistakes of Alan Greenspan, former chairman of the Federal Reserve, who encouraged the tech bubble and the housing bubble. Despite the pain caused by these events, Grantham states that we have not learned from our mistakes.
And the bottom 50%, I can assure you, has not doubled its wealth. The dominance of a handful of firms has increased steadily in most subsets. And so profit margins have gone up, and the power of corporations has gone up, and they've been able to use more of their power in influencing government, and they have. There is a lot of regulatory capture where people from business tend to run the agencies that regulate the industries. So it's been a wonderful time to make money at the corporate system, and the share of GDP that goes to corporate profits has steadily risen, and the share going to labor has steadily fallen. This makes it a dreadful cousin with the asset class inflation that we've had. They both have two things in common. They make the rich better off, and they make the working class worse off. And that I think is the great poison at the moment in the American system. If we do not address rising inequality, we will be in real trouble. We are the least equal society, measurably, in the developed world. We have the least fluid economic mobility, for heaven's sake. You know, when I arrived in America in the 60s, it was a joke how rigid the UK was. The UK is now less rigid than the US. The number of people moving from the bottom quarter to the top quarter in a lifetime is half of what it is, say, in the Swedens of the world, in the US. We are the least mobile. I mean, this is so un-American. It is so far from what people believe to be the case. But check it. We're the least mobile, we're the least equal society. And it's a poisonous influence. And we have facilitated it. We have moved the taxes on capital gains tax, dividend tax, interest tax. We've moved them down, and by definition, the amount that has to come from income has gone up. And of course, there's a bubble element to all that. And some of it will be priced much more highly in the last few months than it will be sometime in the next couple of years as the bubble fully breaks. But in the end, Look back at the Amazons, look back at the internet bubble. There was a lot of money wasted, but my God, it did push along the technologies of the internet. And it was the US who emerged with the Amazons and the etc., the AOLs of that era.
Grantham has been warning about the current stock market conditions and the potential for a collapse in stock prices. It's one thing to predict a collapse and another thing to tell investors to sell. What are Grantham's thoughts on how investors protect themselves?
As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest. It's also true that the value end of the spectrum, as opposed to the growth end, is about as cheap as it gets. So if you can combine those by buying value stocks outside the US, I would say particularly emerging markets, but there's quite a few countries, Japan, the UK, where the markets are. If they're overpriced, they're only moderately overpriced. The US is not moderately overpriced. It is shockingly overpriced. But let me remind you that in 1929, you didn't get back in real terms until about 1954. That's a long wait. In 2000, you didn't get back for 13 years. By modern standards, that's a pretty long wait. And in Japan, which is really the granddaddy of both bubbles, land, and stocks, they are not back to their 1989 peak today. That is a very, very long wait. So if you think you can stand it for 10 or 20 or even 30 years, be my guest. But history says a lot of you will not stand it. A lot of you will become more conservative deep into this kind of correction.
While it's difficult to predict exactly when a crash will occur, it's crucial to prepare and protect your financial future. What are your thoughts on the current state of the economy? Do you agree with Grantham? Should investors be selling? Join the conversation and tell us your thoughts in the comments below. Thank you for watching. If you found value in this content, feel free to share and like this video. Subscribe and hit the notification bell for more videos on investing, finance, and the economy.